Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. Thank you so much for the recent support. And in today's episode, I'll be doing something that is slightly different. I'll be covering 3 different quality stocks that are attractive in today's market. And of course, this is my portfolio here. Feel free to check it out if you're interested. This is a Substack that I've written on our weekly newsletter. Feel free to check it out, link in the description below. So I'll be covering 3 different stocks that I view as attractive. And before that, let's start off with this article here. So this article over here says that the best time to buy quality stocks is now. It is a generational opportunity in otherwise bubbly markets because quality stocks have actually underperformed the broader markets by over 10 percentage points over the past year. So quality stocks are underperforming the major indices, with most retail investors chasing momentum and AI-driven companies. But recall what Benjamin Graham actually said. He said, in the short run, the market is a voting machine. In the long run, the market is a weighing machine. Most companies, they compound because the earnings per share is increasing over time, not so much because the multiple expand. Multiple expansion can only bring the stock to a certain level, but earnings is actually the one that drives up the stock price in the very long term. So our philosophy over here is different from all your different other YouTubers out there, a lot of your retail investors as well. We focus on high quality companies that meet the threshold. And in today's article here, I'll be covering 3 stocks that are attractive or getting attractive soon. So one more thing to note, this is an important concept that every single investor needs to know. So returns are driven by changes in expectation about future cash flows and the rate at which those cash flows are discounted. So rate at which those cash flows are discounted refers to the risk of the company. So if the company becomes less risky, your discount rate goes down. And what that means is that your future cash flows, they become more valuable. Stocks go up because of revisions of expectations upwards, and they fall when a company reports disappointing results that reduces expectation. So for each stock in here, I'll be covering the reasons why the stock will see a revision in terms of expectation. First stock that I'll be covering is MSCI. This is a toll booth company. So what MSCI does is it sells data, it does ratings, your ESG ratings, and the most important part of the business is actually the indices portion of the business. So what they do is they license out all these indices to asset managers, ETF providers, and asset owners, which include your sovereign wealth funds. And the entire sequence of how this thing works is as such. So MSCI, they create the index and then they brand it under the MSCI name. And then according to the client's needs, they will license out all these indexes, your ETF managers, your asset managers. And then your asset managers and your ETF managers, what they will do is they will go and create products and then sell it to the end consumer as your ETFs that you see online right now. So alternatively, asset managers, they use MSCI index as a benchmark against performance as well. So MSCI's index portion is a critical part of the business. It is currently around, I believe, 60% of the entire revenue chunk of the business itself. So you have one portion of this index portion that is recurring. You have the other portion that is linked to asset-based fees. So it's about a 60-40 split. And for this company, the reason why the index portion is so sticky is because once a company's entire benchmark or ETF is made with MSCI indices, it is almost impossible for them to switch, because if they switch, then number one, it leads to regulation scrutiny, because imagine you swap from MSCI to an unbranded index. That might raise some queries about the benchmark that you're benchmarking against. And then second of all is you will lose trust in terms of your consumers. And then when that trust is breached, you will risk losing assets under management, which is ultimately not what the asset managers want. Secular tailwinds for MSCI include inflows, that is liquidity coming into the markets every year, and of course, increasing shift from active to passive investing. So active investing is buying individual stocks. Passive investing is just buying your ETFs and then letting your money compound. So more and more people are actually swapping over from individual stocks to passive investing. They're just buying the S&P 500 ETF and then allowing it to run. Most people don't even understand the idea of stocks and they're just putting money into the S&P 500. So we're seeing more of that right now. MSCI has risk as well. So first of all, the risk would be pressures to lower assets under management fees, which is your expense ratio. Second of all, it's your market downturn. So that brings me to the several theses that allows MSCI to generate alpha in this market. First of all, MSCI's indexes, they are heavily tied to non-US equities, non-US stocks. So ex-US, the global market trades at 15 to 18 times forward earnings, whereas your US stock, they currently trade at around 22 times forward earnings. So that represents around a 40% discount for your non-US equities as compared to your US equities, as you can see over here. And every single time we reach this 40% level, we'll see a sharp rebound. So we saw that in around, I believe, 2003, somewhere here. Saw that in 2008 also. Saw that in 2020 when we had a jump back to 20%. So given historical mean reversion patterns, improved fundamentals in ex-US markets, and persistent valuation gaps, it is highly likely that non-US equities will re-rate upwards relative to US equities over the medium term. So history has shown that 40% discount does not persist. So for MSCI, they have around, based on this chart over here, they have around 75% of their ETFs linked to non-US equities. Only 25% is linked to your US equities. Second thesis for MSCI is that the company's core business is extremely strong. It is a highly defensive, highly defensible business, and decline in growth is currently overstated. So sentiments linked to the stock are as such. Number one, your ETFs are going to have lesser fees over time, they have lesser expense ratio. And then what happens as a result of that is that MSCI's economics will suffer. This is the common consensus. But counters to that will include, number one, most of the decline is already behind us. So your expense ratios right now, they're currently around 0.05%. That is extremely little as compared to what it was maybe 20 years ago. Second of all is that decline will start slowing from here, and MSCI will benefit from this slower decline. So MSCI's business is defensible with significant barriers to entry. So we'll try and use a framework here, which is called your Porter's 5 forces, which include your threat of substitutes, new entrants, bargaining power of customers, suppliers, as well as rivalry amongst competitors. So threats of substitute means, is there anything that can substitute your MSCI indexes? Currently it's minimal. The only way you can circumvent this MSCI indexes is by using robo-investors that help you index your stocks on the brokerage platform. And besides that, there's another one, which is AI-driven portfolios or synthetic indexers. Could be seen as a worthwhile risk in the future, but most institutional investors and ETF providers won't adopt unproven providers or critical benchmark because of the trust issue. So this is a very small problem that is almost non-existent for MSCI. Second of all is the threat of new entrants. It is low due to high regulatory barriers as well as stringent licensing and legal requirements. Bargaining power of customer is also very low because there is no competition and the customer switching cost is extremely high. As for rivalry amongst competitors in the space, your key rivals include S&P Global, Dow Jones, FTSE Russell, and then you have other indexers in individual countries. Rivalry exists, but it's mitigated by MSCI's first mover advantage and global reach as well as the scale. So switching costs and integration make risk less threatening. The competition is almost mitigated, and there is very minimal competition in this oligopolistic environment for MSCI. So in sum, MSCI is trading at a discount relative to historical multiples. This is the 5-year price to free cash flow, and the median price to free cash flow is actually around 35 times. The stock is currently trading at a 27 times of price to free cash flow. So historically, the company is trading at a discount. The CEO has been conducting a lot of buys recently. So it's a signal of the stock's undervaluation, and that is why MSCI is the first stock in this list over here. Next part, I'll be covering the second stock that I view as attractive in today's market or approaching attractive levels, and this stock is actually Netflix. So as discussed in the previous newsletter, one of the main theses driving Netflix earnings growth is their new ads segment of the business tied to the ad tier subscription. So there's a lot more demand for the ad tier portion, because the ad tier portion, it costs $7.99. The non-ad portion costs $17.99. So it's natural human behavior to want to opt for the cheaper subscription. So just some numbers here, ads bring in around a CPM of $20. Expected CPM is closer to around $13. This is the CPM that I calculated, such that the ad tier pricing is exactly the same as the non-ad tier pricing. So baking those numbers into the assumptions, ad tier revenue is closer to $23 compared to non-ad tier, which is $17.99. This implies a 30% increase in terms of revenue if they're able to switch the non-ad people to the ad tier portion. So Netflix has also signaled that their ad division is growing rapidly with 65% of users signing up for this ad tier portion. This is logical, and just some assumptions that I actually made over here. So this is a simple model that I created for Netflix. It's a simple one, so we'll try and take a look at the numbers here. So I've actually modeled out the different revenue growth chunks, and here are some of the assumptions that I made for the company, as well as the model here. So first of all, I modeled the revenue based on the SVOD growth over the next 5 years. That's the expected SVOD growth. SVOD meaning your streaming platforms. And then second of all, I added market share gains in each of these different segments as well, based on the past 3-year trends. And then after that, I added the ad tier benefits for this North America portion. So all the other portions, I didn't add any ad benefits because they're currently still rolling it out. I believe they have around 12 countries that have this ad tier portion. It's still very underpenetrated in the other countries, so I decided to neglect it. And these can be said as understating the earnings. I actually got EPS for Netflix at around $6 a share. So my net income margin is actually projected to increase over time. This is modeled to converge with YouTube's net income margin over time. So this year is around 24%. This is because of the one-time expense. Next year is closer to around 27, 29 and so on, all the way until it reaches something that is close to YouTube's net income margin. So based on all this, as well as a 30 times price to earnings ratio, I got $179 for Netflix shares in around 5 years time. Of course, the worst case can come whereby you have an economic slowdown and then your pricing starts to slow down, and then everything starts to fall apart because consumer discretionary products are tied to the economy. But based on these assumptions here, Netflix is currently offering around a 12 to 13% CAGR. So a reasonable price to enter into Netflix is closer to around $85 a share. That is when I think I will enter into the stock with a decently sized position. Not a crazy 10% position, but one that gives me enough exposure to build confidence and build conviction over time. Last stock that I view as decently attractive today or approaching attractive levels, I think it's more of approaching attractive levels, is actually Ferrari stock. So Ferrari is a company that has been extremely durable despite being a completely discretionary product. The stock is down following their Capital Markets Day event, where they disappointed Wall Street estimates with their 2030 guidance. So as you can see over here, this is their 2030 guidance. They're modeling around $11.5 of adjusted diluted EPS in 2030. This is without adding buybacks. And if you calculate based on the estimates, it's around 5.5% CAGR from their 2025 estimate. And if you add in the buybacks, which is around 1%, that would represent around a 6.5% CAGR over the next 5 years, which seems underwhelming because the stock has been growing rapidly in terms of net income over the past 5 years. So this has led to a massive re-rating of the stock. The stock is currently trading at a 34 times of earnings, and the median over the past 5 years is around a 40 times. The last time we got this low was in 2020, that was during the COVID period, and in 2019, when we had the tariff debacle over here. But there are a few things that investors have to realize when investing in companies. So every company's value is determined based on the DCF of the company, which is your discounted cash flow analysis. And if you look into your DCF calculation, a majority of your value is actually derived from your terminal value of the company, which is derived from your terminal growth rate. So a major component of your DCF is actually the terminal growth rate of the company. That's why there's so much emphasis being placed on companies that are predictable. Because if the company is predictable, then you will comfortably be able to project growth well into the future. And in the case for Ferrari, this is a company that is extremely predictable. You will likely see 5-6% growth for the next 20 years because they're able to increase prices at these rates. The CEO has named Ferrari as a luxury brand that sells cars. They keep supply scarce to increase the perceived value of their cars each year. They increase prices every year as a way to respect the customers that buy the cars for prestige, and at the same time, it helps with better economics as well. The moat is very strong for this company. So zooming into the 2030 guidance, this was what I gathered. So first of all, they're projecting around flat margins over time. In fact, I think the margins are declining based on the numbers. So I suspect the main reason for this margin decline is because of two reasons. Number one is that they're projecting increased material costs over time because of your EVs coming up. So when EVs coming up, more demand for your materials like aluminium as well as steel, That's why Ferrari is projecting increases in your cost. Second of all is that they're spending a lot of money on R&D. So what they're doing is they're trying to push out that EV model, which they currently don't have yet. And in order for them to do that, they need to pour money into R&D for electrification. This is what the management has said. So that is why there is decrease in terms of margin, or at least flat margins, with this immense pricing power of Ferrari. So while Ferrari is not a value investment today, if an investor is able to hold on to this company for the next 20 years, this is a great company to consider with high amounts of predictability. So for some context, Ferrari's revenue increased by 6% in the trailing 12 months, while volumes have increased at a modest 0.5%. This implies a 5.5% increase in terms of pricing, as well as mix of products. So mix of products means they sell more expensive cars to the end consumer. When you have a company that is able to increase prices at this rate, once commodity prices, your cost of materials like steel, aluminium, they start to normalize again, that is when you will see much stronger growth from Ferrari. And I suspect this time, the management is doing the same as what they've done in the recent years, which is to give out conservative estimates and to beat it well ahead of what they're projecting. So for context, I think the last time that they did this capital markets event was in 2022, and they actually beat these estimates that they put out in 2024, which is last year. So they beat this year's estimates last year. I suspect they're doing something similar as well in terms of their guidance. They're giving out conservative baseline, lowest case guidance. The mid case is probably slightly higher than what they're projecting, meaning around 10% growth for the company. Anyways, I hope you guys have found this video useful. It's a slightly different one. Feel free to check out the Substack, link in the description below, and I'll see you guys soon.